Alright, in this video I want to go over IRS Form 6252. This form is attached to your 1040 and it's used to report installment sale income. So what is installment sale income? Well, as a U.S. individual taxpayer, you recognize income under a cash basis, right? So businesses can be cash basis or accrual. For individuals, it's generally always just a cash basis method. So when you actually constructively receive income in that tax year, that's when you report it as income and you pay taxes on it. Under an installment sale, you could sell property but not get all of the cash up front, right? Or in the year that you actually sell the property. You might get it prorated over a several year period. If that's the case, then you don't have to record all of the gain in the year that you sold the property. You can record the gain into taxable income ratably over a several year period as you receive the cash. So in this example, we have John here, individual taxpayer, and what John did was he sold a vacation home that he owned to a buyer, and under the terms of the deal, the buyer is going to pay John cash equally over a 5-year period, right? So if John sold the property in 2020, but he's not getting the cash all up front, he's going to record the income under the installment sale method. So let's go through the form and John's example in a little more detail and see how this ultimately gets reported on his 1040. So here we have the 6252 for John. He's a taxpayer. And the description of property here, he sold a vacation home, right? So it's just a piece of residential real estate. He wasn't renting it or anything like this. This is just a vacation home. So he bought it in May 1st, 2018. So he had it a couple years. And then he sold it June 15th, 2020. Okay, so questions 3 and 4, right? He didn't sell this to related party. That is important because there are certain related party rules regarding the sale of property or when you perform services, but in this case it's not a related party, so he checks no. And so here let's look at the terms, some of the actual numbers on the sale of the property. So the selling price of the home was $125,000, and when John purchased the property, his basis was $105,000, right? So that's his cost basis in the property sold. So John bought it for $105,000 in 2018, and then he sold it for $125,000. Now, okay, so then the total gain on it, right, is $20,000. $125,000 minus $105,000, $20,000 was his profit. Now, under the installment method, remember the buyer is going to pay John equal installments over a 5-year period, right? So he's going to pay John $25,000 in the current year and then $25,000 every year thereafter until he's paid up the whole $125,000. So how does John record the actual gain? Well, the first thing you need to do is figure out what is the gross profit percentage of the transaction, right? So he had $20,000 in profit divided by $125,000 contract price. That gives him with a gross profit percentage of 0.16 or 16%. Okay, so 16% is the amount of gross profit or the gain he's going to recognize every time he receives income. So in the current year, he received $25,000. So $25,000 times 16% is $4,000 in installment sale income. So John is going to record $4,000 of gain in the current year because he only received $25,000 of the total $125,000 purchase price, right? And so every year thereafter, John's going to keep recognizing $4,000, assuming he gets $25K each year. And then after a 5-year period, right, $4,000 this year, $4,000 next year, $4,000 third year, and so on. Ultimately, he will be recording this whole $20,000 in capital gain, but it's just going to be spread out over a 5-year period. So part 2, this is where you calculate the actual amount of gain. Part 3, you can leave blank unless it is a related party, but in this case, like we said, it's not. So he's got $4,000 in installment sale income. The $4,000 in capital gain income is then reported on Schedule D. Right, so Schedule D here, we have the capital gain and loss schedule. And so the $4,000 is reported here on line 11. Okay, so there's the $4,000. in long-term capital gain, and ultimately that is going to flow through to page 1 of his Form 1040 on line 7, right? So that's how it's done. It's relatively straightforward. It's a very good planning technique if you are going to sell something and you're not getting all the cash up front. Definitely explore using an installment sale treatment to make sure that you're not paying all this tax when you haven't actually received all the cash yet. Now, obviously, you are allowed to record all of the gain in the year that you sold it, even though you don't get the cash. You can do that, but in John's case, he just preferred to only kind of record the gain as he gets the cash, which is fine. You're certainly permitted to do that if you're a individual taxpayer, because again, as an individual taxpayer, you operate under the cash basis method. So that covers it for this video on 6252. Thank you for watching. If you have any questions, please leave me a comment below in the video. I'm happy to answer any kind of questions that come up, and I hope to see you again soon. Thank you.